Hello and welcome back to the IEA's podcast Everything Energy. I'm Dan Hewitt. Countries and companies can make big promises about energy investment. But if you really want to know what's happening, sometimes there's only one thing to do: follow the money. That's exactly what the IEA's World Energy Investment Report does, tracking where money is flowing across the energy sector. Despite economic uncertainty, global energy investment is on track to reach a record-breaking $3.3 trillion this year. Clean energy technologies are set to attract two-thirds of that, while for the first time since the COVID-19 pandemic, investment in fossil fuels is expected to decline. To unpack what all this means and learn where the energy sector is putting its financial muscle, I'm joined by Cecilia Tam, head of the IEA's Energy Investment Unit. A quick note before we start, that this episode was recorded on June 12th, the day before the significant escalation in tensions between Israel and Iran, which caused a spike in oil prices. Okay, Cecilia, so thank you for joining us. Now, this conversation is based on the World Energy Investment Report, but perhaps we could just take a step back and you could tell us, why is it important? What are the key things that it's trying to shed light on?
The World Energy Investment Report is our first look at where the world is spending in the energy sector. It looks at how much is being spent across different energy technologies and energy sectors. It looks at where that spending is taking place around the world. And it also looks at how different markets and different regions are addressing some of the key issues that are of major concerns to both companies as well as major countries.
So this report identified key themes about the way that the world invests in energy. So what were some of the key themes from the report that jumped out to you?
This report really looked at, as it was our 10th edition, we did a special look at what we've learned in the last 10 years of investments into the energy sector. And what we saw were a few things. First of all, one of the major drivers that we're seeing in energy investment is really around energy security. So how countries as well as companies are thinking about investments are really driven in many cases by energy security concerns in major countries such as China, Europe, India, as well as the United States. We also see a growing shift towards investments into the electricity sector. And in the last 10 years, we've also seen a big shift in how companies and countries are investing around the world, where 10 years ago, the world was investing quite heavily in fossil fuels. Today, we're actually spending twice as much on renewables, nuclear, grids, and batteries, on energy efficiency and end-use electrification, as well as low-emission fuels, than we're investing in fossil fuels. So while in 2015, these were pretty evenly paired, today the world is spending much more on a wide variety of different low-emission technologies.
Okay, so let's dive down a little bit more into some of those ideas and some of those figures. So global energy investment in 2025 is expected to reach 3.3 trillion. Now, you mentioned that split between clean energy and fossil fuels. Can you tell us a bit about how that 3.3 trillion is going to be divided?
As you mentioned, clean energy is now receiving the largest portion of investments at about $2.2 trillion. Fossil fuel spending for 2025 is estimated at $1.1 trillion. And in the low emission space, the largest amount is going towards the power sector, with about $1.5 trillion invested today in a wide variety of generation sources, but also in grids and in storage. We see solar being the largest single source of investments in the energy sector today, as well as the first year-on-year decline in investments in upstream oil, which is quite a particularly striking trend for this year.
Now, there's a lot of economic uncertainty in the world today. And I think perhaps people felt for some time you were either choosing between energy security or renewables. But that's not really what this report showed. Why is that?
What we saw is that when we look at energy security, the way countries are investing in security has changed dramatically over the last 10 years. And I think China is a very interesting example of how their long-term thinking and concerns around dependence on fossil fuels with very big fluctuations in prices over this time period has driven them to invest quite heavily in a wide variety of technologies, from renewables to electric vehicles to batteries. And this long-term investment has really paid off, with China being the leading manufacturer across many of these technology areas. And we're also seeing very positive news in terms of dramatic reductions in costs that has allowed different countries, particularly fossil fuel poor countries that are reliant on imports of fossil fuels, to invest much more heavily in domestic sources, including a wide variety of renewable technologies, but also things like nuclear, as well as energy storage and efficiency and electrification investment.
Now, the report also speaks about investors adopting a wait-and-see approach. Could you tell us a bit more about what is meant by that? Are they waiting to see the price points for certain energy sources? Maybe you could tell us a bit more about that.
I believe what you might be referring to in this sort of wait and see is what's happening in the oil sector. What we're seeing today is that the return to a low oil price environment is leading many of the oil companies to reconsider some of those investments in upstream oil. So in this edition of the World Energy Investment Report for 2025, we are forecasting a 6% reduction in investments into oil. And we see this as a reflection of some of the uncertainty in oil demand. China's shift towards e-mobility has really transformed not only the country's energy sector, but I think global energy markets. 10 years ago, China represented the largest growth market for oil demand growth. And over the next 10 years, our expectations is that oil demand from China will be flat or even declining, as it's gone very heavy on investments into electrification, not only for vehicles and transport, but also in other areas across industry and buildings. And this really indicates that peak oil demand is getting closer. Some reports have already announced that perhaps China's peak oil has arrived. The data is too early to really know that, but that's something that we're watching very closely, because this will have tremendous impacts on what that means for global oil demand.
At the beginning of our conversation, we were talking about how the picture of investment has changed over the last decade, and you mentioned China. I think it's worth just returning to China, and I wonder if you could give us a sense of scale about how far ahead they are from other countries or other blocs, but also how important their investment is on renewable energy sources as well.
Over the last decade, as I've mentioned, China really stands out in terms of how much it invests across different energy areas. So 10 years ago, they were already the largest investor in the energy sector at about $900 billion. The US was actually quite close in second place, investing just below $900 billion. Now, if we jump to today, so in just 10 years, China has really moved ahead, investing an additional $350 billion. It remains and it retains its number one position in terms of overall energy investments, but it's really pulled out far ahead. And this has really been driven by rapid spending in a wide range of low-emission technologies, including on renewable energy, but also on nuclear, as well as on energy storage and electric vehicles. In pretty much every category, with the exception of grids, China is the largest investor across the energy landscape.
Okay, so that's the picture between America and China. But perhaps you could tell us a bit about what's going on in Africa, because there's a very different picture there.
Unfortunately, what we saw this year in Africa compared to 10 years ago is that spending on the energy sector has declined by about 1/3 in 2025. 10 years ago, Africa was investing about $150 billion. A lot of that, and the vast majority, was in fossil fuels. Now, Africa has really suffered from higher interest rates as well as high indebtedness levels. And this question around debt sustainability is really putting a lot of pressure on the region's ability to continue investing. Low oil prices also have not helped. While we did see some positive developments in terms of increases and significant increases in spending in renewable technologies, that drop in spending in fossil fuels has led to an overall decline in investments in Africa. And if we look only at clean energy, Africa only receives 2% of global spending on that very wide basket of low emissions technologies, despite representing 20% of the world's population.
Okay, now let's just step back, and I want to dig a little bit more into individual renewable energy sources, because you mentioned that solar was the big winner. Now maybe you could tell us a bit about how the price point has changed. Are people making money from investing in it? But I'm also interested to know if the surrounding technologies are keeping pace.
Over the last 10 years, spending on solar has pretty much tripled. And as I mentioned earlier, is the single largest source for investments into the energy sector at about $400 billion for this year. We have something called the Clean Energy Manufacturing Index, which tracks a portfolio of different technologies from solar to wind to batteries. And over the course of the last 10 years, the index has fallen to well below half of those levels, indicating the really increasing cost competitiveness of not only solar technologies, but wind as well as batteries. But one area that we're not investing enough is in grids. So this year, while we do see important increases, reaching just over $400 billion in grid investments, if we compare that to the roughly $1 trillion that we spend on all types of electricity generation, we're clearly not investing enough. By the end of this decade, the IEA has been calling for hitting parity, so investing equal amounts in electricity generation as we do on electricity grids.
And I think that's a good time actually to talk about roadblocks. Do you think that the investment in the grid, do you think that is the key roadblock we have seen when we come to running out the clean energy transition? Are you concerned that the investment into the grid is happening fast enough?
Unfortunately, as we mentioned earlier, we're clearly not spending enough on electricity networks around the world. Now, we need to look more into more regional detail. So the U.S. is a bright spot in grid investments and is the single largest region that invests 1-for-1 in terms of spending on grids as they do on electricity generation. But particularly in the emerging and developing countries, we are falling behind in how much we spend on electricity networks. And one of the reasons for this, in addition to the high cost of capital in these markets, is the fact that most of the utilities in developing countries are owned by the government. And we need to see significant reforms of the state-owned utilities to really strengthen their position to be able to continue investing enough to meet demand, as well as to meet the very important goal of achieving universal electricity access.
Okay, I just want to dig a little bit more into fossil fuels, because there's this big headline figure that there's been a drop in investment for the first time since 2016 when you take out COVID. But there's a difference in the way the world has invested in coal and gas. I wonder if you could tell us a bit more about that.
Sure. So in terms of gas investments, we're seeing quite a lot of investments into LNG expansion. And we anticipate that in the coming years, there'll be a 50% increase in the amount of LNG export capacity around the world, with countries such as the United States, Qatar, and Canada investing quite heavily on LNG exports. In the case of coal, for energy security concerns, we see countries such as China and India investing quite heavily in new coal-fired power plants, with China alone adding about 100 gigawatts in new coal-fired capacity as FIDs this year, and India about 15 gigawatts. Coal supply, we are also seeing increases in spending on expanding domestic resources of coal in China and to a lesser degree India, but also for building up new capacity and modernizing existing mines. It's too early to see really what the overall impact of all of these investments in coal will be, particularly for energy-related emissions, but it's something to watch very closely, but really emphasizes that concern that many countries have on ensuring energy security and how they're addressing that through their different energy investments.
Just staying with fossil fuels for the moment. Now, the report mentions international oil companies invested 25% less in low emission technology than the year before. I think the figure was about $22 billion. I'm interested to know why that might be.
So it's a combination of factors, but I think if you look at the details of the numbers, spending on low emissions fuels by oil companies is concentrated in just 4 companies, BP, Equinor, Shell, and Total Energies. 3 of these 4 companies have announced large reductions in targets for spending on low emission technologies. And this has very strong implications on how the overall spending by oil companies will turn out this year. Now, we see some increases in spending in new group of smaller oil and gas companies, as well as in with national oil companies. But they're not strong enough to compensate for that reduction by some of these large companies that have been the biggest sources of low emission spending.
Now, I want to talk a little bit about COP28, because on the one hand, you have the words, the promises that are made, but now we're looking at the numbers. Do you think, from what we've seen about the way that the world has been investing in energy, is it enough to meet some of those pledges, some of those promises made at COP28?
So looking at where we're falling behind, it's on the doubling of the improvement in energy efficiency. To achieve that, we need to increase spending by 3-fold. Unfortunately, spending on energy efficiency continues to fall behind. And if we are going to hit the COP28 target for energy efficiency improvements, we need to accelerate much more spending on energy efficiency.
In terms of roadblocks, we mentioned the grid earlier. Is there anything else that is a moment for concern for you about the way that money is being focused? Is there anything else that needs to change more rapidly than it's currently changing? What else jumped out at you from the report?
Something I want to come back to is really what's happening in developing countries. So while we're doing well on spending for China and advanced economies, and in some large emerging economies, we really aren't spending enough in developing countries. And I think the high cost of capital, higher interest rates, high debt levels is really keeping many of these developing countries from achieving some of these long-term pledges And going back to, the critical need to meet the 2030 target of universal energy access, both for clean cooking as well as for electricity access. And we need more support from the international community to ensure that these markets can achieve affordable transitions. And this is going to require more financial support to developing countries and more targeted interventions that can enable more investments going to developing countries for renewables, for energy efficiency, and very importantly, for clean cooking, as well as electricity access, which is going to be a combination of spending on distributed renewables as well as on electricity grids as well.
Now, in the past, the IEA has spoken about the age of electricity. First of all, perhaps you could just remind us what that means, but do the latest figures about where the money is flowing to, do they support that statement?
Very much so. I think what you're seeing is that today electricity demand is growing at twice the speed of growth in fossil fuels. We're now spending about $1 trillion a year on new generation assets. This is up from just $600 billion 10 years ago. Electricity demand is rising at about 30% over this last decade. And new investments in generation are growing twice as fast. Now, we are actually seeing also significant spending on electrification, not only for transport in electric vehicles, but also for heat pumps, as well as very heavy spending on artificial intelligence, which is really driving new investments into electricity generation. So at least in terms of energy investors, we really see this age of electricity already being here.
That's great. Well, Cecilia Tam, thank you very much for joining us.
Thank you very much.